What if I told you that some of the biggest investment opportunities are hiding in plain sight, trading for less than $10 per share? Imagine getting in early on a company before the market catches on, watching your small investment turn into something huge. Sounds impossible? It's not. Some of the best growth stories started exactly this way. Today, we're diving into 3 cheap stocks with the potential to deliver massive returns. These companies aren't just random picks, they operate in payments technology, healthcare technology, and water resources. 3 industries that are growing fast and shaping the future. Now, before we get into it, do me a quick favor. If you love discovering underrated stocks, learning smart investing strategies, and staying ahead of the game, hit that subscribe button and turn on notifications. That way, you won't miss any of our future deep dives into the market. Alright, let's get started. 3 stocks under $10 that could be your next big win. Paysign, a company that's flying under the radar but making some serious moves in the payment technology space. Now you might not have heard of them, but if you've ever used a prepaid debit card for work, healthcare expenses, or government benefits, there's a good chance Paysign was behind the transaction. But here's what makes them interesting. Instead of competing head-on with giants like Visa or MasterCard, they're playing it smart, focusing on healthcare payments, government transactions, and corporate incentives. These are massive industries that are growing fast but haven't been fully tapped into by the big players. One of their biggest success stories? Patient affordability programs. These specialized prepaid cards help people manage medical expenses, and this segment alone grew by a staggering 219% in the last year. That's not just solid growth, that's a company executing a strategy that's working. Alright, let's talk numbers, because this is where things get really interesting. Right now, Paysign is sitting at a market cap of $144.5 million, not the biggest player, but definitely one with room to grow. Earnings per share, EPS, at $0.02495, showing they're making money. A PE ratio of 109, which could mean this stock is still undervalued. And here's the exciting part, they're not just growing, they're growing fast. In Q3 2024 they pulled in $15.3 million in revenue, a 23% jump from last year. That's the kind of momentum that gets investors excited. Even more impressive, their net income climbed to $1.44 million, up from $1.10 million last year. Translation, they're not just making more money, they're keeping more of it. And check this out, gross margins hit 55.5%, meaning they're scaling up while keeping costs low. That's huge because it shows they know how to grow efficiently without overspending. And they're not slowing down. Paysign is on track to hit between $56.5 million and $58.5 million in revenue for the full year, with an expected growth rate of 20% to 24%. That's serious momentum for a company that most people aren't even paying attention to yet. Is Paysign a smart investment? So why is Paysign getting more attention from smart investors? First, cashless payments are exploding. More people and businesses are ditching traditional banking, and prepaid cards are becoming a go-to financial solution. That puts Paysign right in the middle of a booming industry. Second, they're not trying to fight with Visa or MasterCard. They're sticking to their lane in healthcare, government programs, and corporate incentives. These are high-growth industries where big players haven't fully stepped in yet, and that gives them room to dominate. And finally, this isn't just hype. Paysign is delivering results. They're not just growing fast, they're doing it profitably, with strong revenue growth and solid margins. That's what serious investors want to see. What are the risks? Of course, no stock is risk-free. The payments industry is extremely competitive, and while Paysign dominates its niche right now, bigger fintech companies could step in at any time. Another thing to watch? Insider activity. In January 2025, CEO Mark Newcomer sold 61,000 shares of the company's stock. Now, insider selling doesn't always mean trouble, but it's definitely something investors should keep an eye on. Paysign is small, but it's growing fast. With solid financials, strong margins, and a smart market strategy, they could be a huge win for early investors if they keep up this momentum. Lensar, a company that's changing the game in the medical technology space, specifically in eye surgery. If you've ever known someone who needed cataract surgery, you know it's a delicate procedure that requires extreme precision. Traditional cataract surgery is done manually, but Lensar is revolutionizing the process with advanced laser technology. Their systems make the procedure more precise, improve patient recovery times, and lead to better overall outcomes. That's a big deal, especially when you consider that millions of people need cataract surgery every year. And here's why this industry is poised for massive growth. The global population is aging, and the number of people needing cataract procedures is rising fast. As the demand for better surgical solutions increases, Lensar could be in the perfect position to capitalize. How is Lensar performing? Alright, let's break down the numbers and see what's really going on with Lensar. Right now, they have a market cap of 0.12 billion, which makes them a pretty small player in the healthcare tech space. Their earnings per share, or EPS, sits at negative $1.27. A negative EPS indicates that Lensar is spending more than it's earning, which isn't uncommon for early-stage or high-growth companies investing heavily in research, development, and expansion. Their price-to-earnings, or PE ratio, is negative 8.67. That tells us that they're not profitable yet, but it could also mean the stock is undervalued if they execute well. Looking at revenue, Lensar pulled in $42.16 million in 2023, with a net income of $14.38 million. So while they're not consistently in the green just yet, these numbers show they're making serious progress. Now let's be real, being unprofitable isn't ideal, but it's also not a deal-breaker for companies in high-growth industries. What matters is momentum, and Lensar's cutting-edge laser technology gives them a strong competitive edge in the rapidly growing cataract surgery market. If they continue to expand and gain more adoption, they could be looking at major upside in the coming years. Is Lensar a smart investment? So what makes Lensar worth considering? First, the market is growing, the global cataract surgery industry is expanding, and with more people needing these procedures every year, the demand for advanced surgical technology is only going up. Second, Lensar's laser tech gives them a real edge over traditional methods. More doctors and hospitals are looking for high-precision solutions, and if Lensar continues to improve and innovate, they could grab a bigger slice of the market. And third, they're operating in an industry that's recession-proof. No matter what happens in the economy, people will always need medical procedures, and healthcare companies that offer better solutions have a real chance to grow. What are the risks? Now let's talk about the potential downsides, because every investment has risks. First, Lensar isn't profitable yet. That means they're still in a growth phase, investing heavily in technology and development. If they don't scale fast enough, profitability could take longer than expected. Second, competition is tough. There are big players in the healthcare tech space, and while Lensar has great technology, it's going up against established companies with more resources. And finally, medical technology companies face a lot of regulatory hurdles. Getting FDA approvals and meeting strict healthcare regulations can slow down product rollouts, which could impact growth. Lensar is small but ambitious, and they're playing in an industry that has huge long-term potential. Cadiz, ticker symbol CDZI, is a water resource company with huge potential. Water is one of the most valuable resources on Earth, and Cadiz is betting big on it. This company owns a massive aquifer in the Mojave Desert and has plans to supply fresh water to drought-affected regions in California. If they secure the right approvals, they could turn that water supply into serious revenue by selling it to cities, businesses, and farms in desperate need of a reliable water source. California has been battling water shortages for years, and with climate change making droughts even worse, the demand for fresh water isn't going away anytime soon. If Cadiz gets the green light to fully commercialize its water resources, this could be a game changer not just for the company, but for the entire state. Alright, let's break down the numbers and see where Cadiz stands today. Market cap $0.38 billion. A solid valuation considering they're not fully operational yet. Revenue $5.54 million. Not much for now, but remember, this company's potential is in the long game. Net income $31.45 million, a surprising number given their low revenue. This suggests they're managing their financials well while working toward full commercialization. Price-to-earnings ratio negative 8.31. This doesn't automatically mean it's a bad investment. Many growth companies operate at a loss while reinvesting in their business. Earnings per share negative $0.62. A negative EPS indicates that the company is not currently profitable. While this isn't uncommon for growth stage companies, it's important for investors to consider whether the company has a clear path to profitability. Things like revenue growth, cost control, and future earnings potential are key factors to watch before making an investment decision. Now I know what you're thinking. $5.54 million in revenue for a company worth over $380 million? Doesn't seem to add up, right? But here's the key. Cadiz isn't fully operational yet. Their true value isn't in what they're making today, it's in what they could make if they unlock the full potential of their Mojave Desert water reserves. Is Cadiz a smart investment? So, what makes Cadiz a stock worth considering? First, water scarcity is a growing crisis, and California is one of the hardest-hit regions. With more people and businesses looking for reliable water sources, Cadiz is sitting on a massive opportunity. If they secure full regulatory approval, their stock price could skyrocket. Second, water rights are becoming more valuable as droughts intensify. Cadiz isn't just sitting on a physical resource, they're sitting on a strategic asset that could appreciate in value over time. And third, they already have infrastructure in place. The company owns a 220-mile pipeline that could transport water directly to Southern California, making distribution a real possibility once approvals come through. What are the risks? Of course, investing in Cadiz isn't without its risks. The biggest challenge? Legal and regulatory hurdles. Water is a highly regulated industry, and Cadiz has faced years of delays trying to get the green light for full-scale operations. If they run into more legal challenges or government pushback, it could slow down their revenue growth. Another risk? Execution. Even if they get the approvals they need, they still have to scale their operations, build partnerships, and ensure that their water delivery system runs smoothly. Cadiz is a high-risk, high-reward play. So, there you have it. 3 stocks with huge potential that are still flying under most investors' radar. Paysign, Lensar, and Cadiz each bring something unique to the table. Whether it's disrupting payment technology, revolutionizing cataract surgery, or tackling water scarcity. And the best part? They're all trading at affordable prices. But let's be real, cheap stocks come with higher risks. Just because a stock is under $10 doesn't mean it's guaranteed to explode. That's why doing your own research is key. Never invest in something just because it sounds exciting. Dig into the numbers, understand the risks, and make informed decisions. Now I want to hear from you. Which of these stocks caught your attention the most? Are you bullish on any of them, or do you see red flags? Drop your thoughts in the comments. And if you got value from this video, hit that like button, subscribe, and turn on notifications so you don't miss out on more stock breakdowns and investment opportunities. The best investors aren't just lucky, they're informed. Thanks for watching, and I'll see you in the next one.